Hello, I'm Will Hoffman from Hoffman Wealth Management. Welcome to the 2023 Annual Outlook from LPL Research titled Finding Balance. During the last couple of years, it's no surprise why we might be striving for balance. If 2022 was about recognizing imbalances that had built in the economy and starting to address them, we believe that 2023 will be about setting ourselves up for what comes next as the economy and markets find their way back to steadier ground, even if the adjustment period continues. The global economy will likely slow from the upper 2% range in 2022 down to the mid 1% range in 2023. Much will depend on China's growth path. An important aspect for investors is that the U.S. appears to have fewer headwinds to growth compared with Europe and other developed economies. The divergence between the domestic and international economies is most obvious in the inflation regime. Germany, for example, is still experiencing accelerating rates of inflation, whereas the U.S. has likely moved past peak inflation. The longer inflation is uncontained, the riskier the growth prospects. One reason we're currently seeing a healthy debate on the likelihood of a recession is that for most of 2022, not all of the metrics were flashing warning signs. However, recent data may give us more clarity. The Conference Board's leading economic index, or LEI, has declined for 7 of the last 9 months, showing that the economy could enter a period of significant and broad-based contraction. The decline is predictable as many sectors, such as housing, started slowing months ago. Since the inception of the index, a decline of this magnitude over a 6-month period has always forwarded a recession in subsequent quarters. As such, we think recession risks appear more probable by the beginning of next year. If the economy does fall into a recession, the cause will likely be from the consumer sector retrenching after years of inflationary pressures. The Fed has repeatedly warned investors about the potential for pain from the fight with inflation. That pain is most likely associated with an expected increase in unemployment as the job market cools from a slowing economy. The job openings and labor turnover report was hardly on center stage until Fed Chair Jerome Powell used a press conference to highlight the number of job openings in the economy. The pandemic caused these 3 metrics to become off balance: the ratio of openings to unemployed, the number of those not in the labor force, and the percent of firms having difficulty finding qualified workers. Investors should watch these metrics throughout 2023 as the economy leads to a more balanced labor market. Housing plays a significant role in the consumer spending, and investors should monitor the housing market as a bellwether for the health of the consumer. Consumers spend roughly 34% of their total spending on housing, so a decline in housing-related costs should give consumers more discretionary spending. If stocks are going to go higher in 2023, a prompt end to the Fed's rate hiking campaign will likely be a key component. The timing of the last rate hike of this cycle is uncertain and won't be clear for a while, but our view is that the Fed will pause during the first quarter of 2023 amid an improving inflation outlook and loosening job market. Should that occur, stocks would likely move higher, consistent with history. Stocks have tended to produce solid gains after hiking cycles end, including a 10% average gain 1 year later. Through many economic downturns, recessions, and geopolitical crises over many decades, the stock market has always recovered. Those patient and courageous investors who were able to take advantage of the declines have usually been rewarded nicely. Following down years, the S&P 500 has risen an average of 15% with positive returns in 15 out of 18 years. Our base case for S&P 500 earnings per share in 2023 is $220, similar to where 2022 is tracking in about $12 or 5% below the consensus estimate as of September 15th, 2022. Revenue will continue to get a boost from inflation as many blue-chip companies during the third quarter earnings season have demonstrated an ability to pass along higher prices due to their pricing power. But margins will likely compress further over the next several quarters. LPL Research's Strategic and Tactical Asset Allocation Committee sees fair value for the S&P 500 at 4,400 to 4,500 at year-end 2023, based on a price-to-earnings ratio of 18 to 19 and $240 per share in S&P 500 earnings in 2024. That target is also derived from probability-weighted scenarios and based on various paths for the economy, inflation, interest rates, and earnings. The path of interest rates will certainly be largely influenced by the Fed's behavior, which will be guided by economic growth and inflation data. Equally important is the level of non-U.S. developed government bond yields, as foreign investors are an important buyer of U.S. Treasuries. Higher foreign market yields, all else equal, generally dissuade foreign investment into our markets. There are a range of scenarios we think could play out over the next year. However, given our view that the U.S. economy could eke out a slightly positive economic growth next year, we think 10-year Treasury yields could end the year around 3.5%. There are some expectations for various fixed income markets under different interest rate scenarios. If the interest rates don't change at all, the best expectation for performance over the next year would be the index's starting yield. Because companies were able to refinance existing debts over the last few years and push out maturities, only about 1% of existing debt needs to be refinanced in 2023, and less than 10% needs to be refinanced before 2025. So the need for companies to refinance existing debt at these higher levels seems to be currently muted. Uncertainty surrounding the course of the Ukraine-Russia conflict has thwarted diplomatic efforts to reach a negotiated settlement. The intense military campaign involves a significant contribution from NATO toward the Ukrainian war effort, specifically from the United States. Depending on how long the fighting continues, it is expected that many of the NATO countries, including the U.S., may debate the financial burden. Markets historically have navigated regional conflicts fairly well, despite the heavy toll. The largest market vulnerability remains the war's impact on inflation. The commodity supercycle spurred by China's hyper growth rate in the beginning of the century has waned significantly. As China's leadership has focused on containing COVID-19 at all costs, the once strong economy has stagnated. Additionally, the boom in real estate projects has slowed dramatically as developers are mired in debt. The 2022 midterm election was closer than many expected, but in the end, voters chose to rebalance the power dynamic in Washington. As expected, Republicans gained enough seats to win a narrow majority in the House, while Democrats held on to their slim majority in the Senate. Despite Republicans' narrow House majority, their victory in the House significantly shifts the balance of power. Since only legislation with broad bipartisan support will get passed once a new Congress is sworn in on January 3rd. Perhaps the most important outcome of the election is simply that we have it behind us. Historically, midterm years have been volatile for markets, and 2022 has been no exception. But the third year of the presidential cycle has historically been the strongest, and a weak 2022 may help set up that pattern again. We would add a note of caution, though, that increased fiscal stimulus in anticipation of the presidential election has often supported returns in the third year of the cycle, and we are unlikely to see that added tailwind next year. The other major takeaway from the election is that we now have a mixed government, with Democrats holding the Oval Office and a majority in the Senate, while Republicans have a majority in the House. Markets have tended to favor mixed government since neither party is able to give in to its worst excesses, and any legislation that does not get passed is subject to compromise. It may also be that the government that governs the best is sometimes the one that governs the least, and a mixed government has a tendency to create that gridlock. If you have any questions, please feel free to reach out to us through hoffmanwealth.com. Schedule a call or meeting to discuss any of your questions. We look forward to hearing from you all soon and wish you a very happy, healthy, and prosperous 2023.